The world is a remarkably diverse place with 194 countries. Every country has rich people, so that means opportunities exist everywhere. Like ancient explorers, investors often look overseas for riches. Today I'll help you navigate the more than 58,000 stocks found across this globe. Why me? I spent a decade at an officer level at the world's leading creator of global stock indices, MSCI. And we always started with a global universe of stocks. The easiest way to invest in global stocks is, of course, to just buy them all. Now, you're not able to do that because of a myriad of different problems. So MSCI starts by defining a series of screens that they use against the global universe of stocks. Here you can see the main three classifications they use. Developed would be countries such as the United Kingdom, Germany. Emerging, such as the BRIC economies, Brazil, Russia, India, China. And frontier would be places like Pakistan or Vietnam. So index providers such as MSCI have these rules in place to make sure that the stocks they're selecting for the various country indices are investable. And when a country becomes investable, the money starts pouring in. So there's a bit of a catch-22 there. But when we look at global stocks, it's very easy to understand what we ought to be investing in when we look at this breakdown. So developed and emerging markets constitute 99% of the float-adjusted market cap. That represents stock that can be purchased by institutional investors. So we can go ahead and put frontier markets on the side and just focus on developed and emerging markets. Now, we recently did a piece on the best ETF, which simply proposed that investing in a market cap weighted index of global stocks, all global stocks, would be a pretty good idea. And since fees are the number one predictor of performance, we settled on Vanguard's Total World Stock ETF, which charges just 7 basis points. That's a really fair price for total global exposure, though you might be able to find a fund these days that's even cheaper. Now, as with any ETF, we can look at the underlying index to better understand the exposure we're getting. And we look at the FTSE Global All Cap Index. FTSE was one of our primary competitors, and they also calculated global indices. Here you can see their Global All Cap Index constitutes large, mid, and small. Now, the MSCI ACWI All Country World Index was typically just large and mid. So this index is quite nice in that you get exposure to companies of all sizes. Now, similar to MSCI, FTSE also applies screens. You can see here investability, liquidity screens, and what they end up with is about 10,000 stocks. You contrast that with the 58,000 stocks available globally, and you see that the actual investable majority of the global stock market is found in a concentrated basket of stocks. And this table is a great representation of these 10,000 names. You can see them broken down there by large cap, mid cap, and small cap. Of course, the majority of market cap there would be in large companies. Let's go ahead and move to a regional picture to better understand what's going on here. Now, the first thing you'll notice is the largest, heaviest concentration is North America at 67%. Well, that's because the United States makes up about 60% of all global stocks in terms of float-adjusted market cap. That's the way that we're perceiving this universe of stocks. And of course, it says 67% here because of the other North American country, Canada, that makes up 6.8%. So if you back that out, the United States is a large component, around 60%. What this means is you ought to have around 40% international equities exposure. What we can then do is back the U.S. out. So removing the U.S., this is the Vanguard FTSE All World ex-USA. So that's all stocks in the world minus the United States. And we can start looking at regional breakdowns, Europe being the largest at nearly 40%. For whatever reason, Joe Retail really loves the BRIC story. So the most questions we get are around investing in China or India or Brazil. These seem to be the most attractive places. So let's drill into emerging markets a little bit. And what we find is some rather interesting tidbits here. First of all, China and India, you see they're representing around 50% of emerging markets. Look at Brazil at just 4%. So it's probably a common mistake that investors would make to think, well, China, Brazil, India, they're all equally weighted in some emerging markets basket. No, they're not, as you can see here. And what else is very interesting is Taiwan. Would you consider Taiwan an emerging market? I mean, I've been there, and I certainly wouldn't consider that emerging at all, but that's because these classifications look at lots of different things that aren't so obvious on the tin. And when we look at how MSCI and FTSE classify emerging markets, we see something even more interesting, that MSCI chooses to allocate South Korea in the emerging markets bucket as opposed to being a developed market. Now, we probably got more questions on the desk about this than I think anything else, and there's quite a bit of research and literature around why that allocation exists, why MSCI chooses to do that. This is taken from the horse's mouth, where they talk about how foreign investors can only trade local currency during Korean business hours with Korean legal entities, and such restrictions may cause tracking errors. They also point to some complex processes for Korean managers that leads to higher costs and fees for the end investor. So until those problems are rectified, they won't be allocating Korea as a developed market. And this piece by Mr. Lieblich here, who I worked with at MSCI, talks about the perception of emerging markets and how you can look at it via a number of different lenses. You see on the left here, that's GDP weighted. Then you can look at it by economic exposure, where our revenue is coming from, and you can look at full market cap. And as I said, we choose to look at float adjusted market cap. So when it comes down to developed versus emerging versus frontier, companies like MSCI assign countries to these categories, and a wealth of factors go into that selection process. Now, corruption is rife in emerging and frontier markets, and you may think there's a lot of alpha to be generated there, but it gets eroded by greasy palms really quickly. Now, some countries like China have rules prohibiting foreign investments. And even people, I think, in these countries will have a tough time figuring out which companies are going to benefit them from an alpha generation perspective. Now, as a foreigner, you're going to have little insight into which countries out there, of the 50 or so in developed and emerging, will outperform over time. It's probably best that you stick to traditional country regional weightings. So let's go back to the Vanguard FTSE All World ex-USA ETF. So this is all countries in the world except the United States, and start looking at the country breakdowns. Rather interesting. Japan, they're at the top, 16%, the heaviest weighted country, followed by the United Kingdom. Then you have China, and you see India represented there, Taiwan. So this really makes the debate about whether or not Taiwan or South Korea should be emerging or developed. It doesn't really matter if we invest at this level. And when we break it down to all the countries, you can see them here listed out and their respective weightings. So what if you happen to think the talent in Vietnam is worth investing in? Remember, Vietnam isn't an emerging or developed market. Well, you can find an ETF for most countries out there, even if they aren't emerging or developed. Here you can see the VanEck Vietnam ETF. Couple things to note. First of all, the total assets it holds is very low at 400 billion, and the net expense ratio is very high at 70 basis points. That's 10 times what that Vanguard ETF was. Investing in single country ETFs is always going to be costly. And for example, if you wanted to overweight China, you'd say, well, I want to find a ETF that covers China. Well, here are the largest ones out there, and look at those expense ratios. So quite spendy when you could simply just get the China exposure from that cheap Vanguard ETF. So you're going to be hard pressed to find any single country ETF that has a 7 basis points expense ratio. So just to summarize ways to invest in global stocks, you can do that with a global stocks ETF, as we showed you, the Vanguard ETF, which is ex-USA. You can do it with regional ETFs, so emerging versus developed, or APAC, EMEA, etc. Country ETFs are going to be very expensive. And then, of course, there's specific stocks. So ADRs, or American Depository Receipts, those are really seamless, and you won't even notice those. They just trade on United States exchanges. Now, properly trading foreign stocks requires a broker that lets you access foreign exchanges. And since half of our audience is from the United States, we'll use them as an example. They may go somewhere and see something cool, a product or service, and think to themselves, I'd like to invest in this. When I went to Hong Kong, I really enjoyed the Cafe Corral concept, and I wanted to purchase shares in that company. Now, the odds are that local people are going to understand the dynamics of a business, product, or service a lot better than you do. So you're at an information disadvantage right away. What's probably better to do is just have a method that selects foreign stocks for you. So for example, we have our Quantigens Q-Score calculator. This is a tool we built for dividend growth investors, and many of our subscribers, 50% of our subscribers and audience are from outside the United States, wanted us to identify international dividend champions because they had problems with U.S. dividend taxation laws. So we identified this universe of 63 dividend champions that are outside the United States. You can see some of the names listed here. We had to lower the champion threshold to 20. So a champion is a company that has not only paid but increased dividends for 25 years. We lowered that threshold to 20 to increase the size of that universe. So that's an objective way to select foreign stocks. Another pool of foreign stocks, some of which we invest in, are based on our disruptive tech strategy. And here you can see some of the names, graphene firms. A lot of those can be found in the United Kingdom. For industrial robotics, a lot of the biggest makers are in Japan. So you have no choice if you want to invest in those themes but to look outside the United States. So if you want to specifically buy foreign stocks, you need to open an account with a brokerage firm that supports foreign exchanges. Then you can go harvest some spoils from your crypto money tree and fund the account. Then identify the currency that the target stock trades in, convert a sufficient amount of that currency, then purchase shares of the stock. Now, of course, your exchange times will be different, so you'll need to wake up in time to trade or stay up late enough. There's likely going to be added exchange and brokerage fees depending on where you're trading. And you'll encounter some strange rules sometimes, like the round lot rules in Japan that require you to only buy and sell shares in round lots of 100, I think it is. But when it comes to firms that let you buy global stocks, foreign stocks, Interactive Brokers is a firm that we've used for well over a decade now. I used to use them all the time for foreign currency transactions since banks are so expensive, and they almost give you spot. You can see here the different currencies that their platform supports, and consequently there are exchanges that you can use this currency to buy and sell shares on. I don't know, 40 or 50 exchanges that Interactive Brokers has, but the menu of foreign exchanges on offer is certainly sufficient for any of the needs that we encounter running either of our strategies. So what should you do? What's the key takeaway? I think you need to start at the asset class level. So, we talk about stocks versus bonds. You need to sort that out. Somebody had put a comment that bonds are return-free risk, which I didn't get at first, but then I found to be quite funny. But this time is never different, so you ought to consider fixed income allocations, consider international bond exposure alongside that. And then when it comes to your equities, so let's talk equities. For international equities, first of all, figure out your U.S. equities exposure. I suspect for many Americans that's 100%. Then establish some target percentage breakdown. What you can do is look to that ETF and index that I showed you, and what was that, roughly 60% United States, 40% international. So set that up, 65, 35, 60, 40, whatever you see fit. Utilize a global stocks ex-USA ETF or fund, all caps ideally, and then use that as a international exposure to counter all your U.S. stocks exposure. At our own asset class allocation level, our international exposure is too low, and certainly that's something that we could look to fix going forward. But going back to that comment I made earlier about the best ETF to invest in, another option, of course, is to simply buy all stocks in the world, including the United States, and let that sort itself out over time. And you can do that by watching this next video in which we highlight probably the best ETF out there. Thanks so much for taking the time to watch this today.